All right. So, $9.51 a share. This must be live right now. Just jumped up to $9.75. So apparently there's upward movement on this stock today. So, what goes into the valuation of the stock? We talked a little bit about this, but let's just kind of rehash. If you're thinking about a stock, what things as an investor should you kind of hone into? What are some key things? Data such as? Oh, beta. The beta. Okay, what do you want to look at a beta for? What did you learn in other classes? That's not something we cover in this class, I don't think.
Beta being how much it moves is the same moves compared to the industry average.
Right, so that was kind of a shortcut method that somebody, I don't think they were named Beta, but developed to kind of look for good stocks to buy. So when you talk about over or under the averages, maybe you're thinking about the beta, what does that mean? I mean, what's your objective?
At that point, it kind of depends on what the individual investor's looking for. If you're looking for something that's going to be sturdy and around that price, but you're probably looking at a decent dividend out of it, then you want to park yourself into a beta that's under one. So compared to the other companies in that industry, that particular company's price does not move a whole lot. It's in a fairly set range. If you're looking for something that's going to grow a lot potentially, but also going to potentially crash, if you're looking for an aggressive growth strategy, you're probably not as concerned about dividends, etc., then you want something with a higher beta compared to other companies in the industry.
So since we're not going to talk about betas, but you guys are familiar with them, what are the elements you're thinking about? What's that? Future cash flows, absolutely, right? So that's one thing that we got to look at as far as what is this thing worth today? And in other classes, including money in banking, but in other ones as well, I tried to set up for how you can value any investment. And so part of it is the future cash flows. What else is the key features to analyzing anything, whether you're buying a classic car, a bond, a stock, a house, a duplex? Future cash flows is huge. What else do you need to know? And that could kind of lump into a few things, but let's try to think about how do I put a price tag on? What's it worth? How much should I pay for the car today? How much should I pay for the duplex today? How much should I pay for the stock today? How much should I pay for the bond today? Right? How do we come up with that price? How do people develop a theory of the price of whether it's a good buy or a bad buy? So future cash flows, I'm with Chelsea on that. So some other things here. Classic car. What's going into your brain here? Duplex.
Compared to its market.
Do we care about the market?
I mean, if you're wanting to know whether or not you got a decent buy on that particular item, yeah, kind of.
Liquidity.
Gives you a good idea.
Okay, liquidity is one thing we mentioned last time, right? So that might be a consideration for a particular investor. How quickly can I dump this thing if I need the cash? That's important. So classic car, a stock, a bond, a duplex, those vary in liquidity. So that would be an important issue. Okay?
I'm thinking back on stocks like on a company, how much debt they have.
Okay, so now you're starting to drill down into the fundamentals of what drove that beta that you guys were talking about, right? So part of that is the underlying fundamentals of the company. If you want to think of it a little differently, suppose you're a private equity firm like Jeff Hull, who's been very successful, by the way, an Auto University grad. I think we're hoping that he'll donate $1 million or more to the university at some point. He runs a private equity firm. What those firms, and those have been becoming very popular, especially since the crisis. So instead of dealing with publicly traded companies, they deal with regular old companies that are not publicly traded. So they're not on the stock market. So how does Jeff go into a company and decide what he should pay for the company, meaning instead of thinking a share price, which, by the way, share price is nothing more than I think the company's worth $2 million, and we have 2 million shares, and so it's $1 per incremental value of how we're splitting up the company, right? So in the private equity case, if you're buying the whole company, you're buying all the shares, you're really focusing in on this top number. Well, stock prices are kind of similar in that regard, right? It's just a share of ownership.
You have your discounted flows, cash flows of essentially every asset in the company and the liabilities as well.
Okay. So yeah, that brings in the flow part. And so back to the stock price, if we flip back now to the market, how do you make money? That's always a good question to just ask yourself when you're looking at anything is, how do I make money? So how do I make money with an individual stock? As an investor, as you deciding whether I should buy that company or not, how do you make money? This is like you guys watch Shark Tank, Mr. Wonderful. How do I make money? How do I send my little soldiers out, and how do the little soldiers come back to me with more friends, right? Is his idea of investing. How do I make money?
Well, if you just invest, you're just buying stocks, you can hold on to them and hope the company goes up in value.
Okay, good. So we have appreciation. Buy that company that we just had on the screen for $9.75, sell it for $10.50. You made that much per share. Buy 1,000 shares, and that translates into some money that you made. That is one very popular way to make it. Buy low, sell high, good old-fashioned way. What's the other way, kind of related to what Chelsea was saying, with stocks? Dividends. So some stocks, not lots of them, but some stocks pay dividends still. It used to be almost commonplace 40, 50 years ago, and now we've kind of evolved towards a zero dividend is maybe okay if everybody's just playing the game of trying to do the appreciation. So John, minus point. Okay. Remember to disconnect yourself from your devices. So how do we lay that out into a formula for the stock price? So my left-hand variable that I want to do is the price today. Price today, P0 equals what? If we're thinking of and let's just think of maybe holding it for a year. Maybe holding it for a year. How do you calculate?
P1 divided by 1 plus I.
Okay, good. By the 1 plus I business, what are you employing? Time value of money. Back to the old present value, future value stuff. That's all we're doing. We take what Chelsea said about thinking about the future cash flows. Time value of money tells us we have to discount those appropriately, right? And then we've got the dividend that we have to do the same thing with. So we've got, that's the only way, that's the only two ways you make money on stocks with a basic stock. You buy low, sell high on the appreciation. If you buy low and sell even lower, it ends up being a negative return, right? So we just get a negative number. So we make money on appreciation, we make money on the dividend. We think about the future cash flows moving forward. We can think about the simple timeline that I'd like you to try to think about. What is the price today based upon? P0. It's based upon what goes on in the future. Over the course of the year, there might be a dividend and hopefully a new price that's higher than the old price. That's the only way you're going to make money in the stock market. So once we break it down to those simple terms, now we pull out time value of money out of our pocket, which we should always have in our pocket as a business major, especially a business economics major for the rest of your life. That time value of money formula is something you can pull out of your back pocket anytime. And so we formulate that with two parts in this case. So our dividend payment, dividend in time period 1 over the course of the year, divided by 1 plus, we're going to use it, we're not going to do I this time, we're going to do K, little k, E. And we'll talk about that in a second. I'm sorry, what?
Is that just the growth rate?
No, it's going to be the interest rate, which I'll define the variables here in a sec. So the dividend payment divided by 1 plus I, if you will, some sort of interest rate. That's going to be really the discount rate. Plus P1, the price tomorrow, divided by that same discount rate. And these are all rates. I'm going to put that in. It's kind of optional. It's not needed, of course, if you have something raised. Anything can be raised to the 1 power. All right, so P0 equals the current price. The current price of the stock. DIV1 is the dividend paid at the end of year 1. Technically, that's the assumption that we make with that formula. It's really coming at the end of the time period. And KE is the required return. The required return on the investment. And P1 is the sale price at the end of the first period. So back to this here. Who determines this? KE. Where does that come from when we figure out what the price is worth? From the investor, okay? So we can look at it 2 different ways. Investors have other options, right? Investors have other options. All investors kind of have the same options at their disposal. So we can look at some sort of strategy that generates the same average investment maybe for all investors. And so in previous applications of the discount rate, we might generalize that to come up with the value of the stock today of what's driving that result. When we decide whether we should buy or not, we can look at our betas, we can look at some of the other data that the stock market cranks out, but we also want to think about our KE. And this is where information might differ among investors. You might be thinking that, oh, the stock's going to be better or worse, and so your required return on this is lower than somebody else's. And then that's going to drive a different result over here. You're going to think that, oh, I think this stock is valued at $10 a share. I just pulled it down on Wall Street and it's selling at $9.75. Should I buy it? Well, part of that decision is the answer would be yes, you should buy it. But it was driven by what your required return was, right? So your particular situation kind of drove the result of whether to buy or not. We're going to do an exercise to kind of work through that. So I just want to get some of the basic equations out of the way first. Okay, questions on that? Layout? All right. So the generalized dividend model is just an extension of what we did for this is really the single period model, I guess, if you want to put a title. So the single period model is, what if I just do it out one time period? And if we have a multi-period model, we're going to do the same thing over multiple periods, how is this going to be modified? How is this going to be modified if we have 5 years, 10 years, 20 years? What does this equation look like? Okay, adding what? This? Again, kind of replicating it?
I mean, sort of, but you're obviously changing dividend payment to price to.
So what gets replicated in a multi-period model? Chelsea? The sum of all the dividends. That's the point I wanted to make, is that this one just gets shoved off till later. So if you hold it for 5 years, we're really looking at the value of the stock 5 years out. In between, all you gathered was the dividends. The dividend was the only stream of income in between. All right, so this model just looks very similar with P0 equal to D1, we're just going to use D1 over 1 plus KE raised to the 1 power plus dividend in time period 2 discounted by that discount factor raised to the 2 power, our normal present value, dot, 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 plus dn, time period n, raised to the 1 plus k e to the n power plus pn discounted by that same factor, however many n time periods we went out. If n equals 1, then we just got what we just did for the single period. Everybody okay with that? Yes?
If you were only given like D0 or like D today, like the dividend for today, would you have to multiply that by KE in order to get D1? Or what would you multiply it by?
If it changes over time,
Yeah.
okay, we're assuming that it stays fixed over time with this, and then that's going to be our next extension, the Gordon growth model. We'll add that innovation on it. If you guys are 20-something, and you plan to retire at 60-something, and you're 40 years out, what's this approximately equal to? If you bought some Apple stock today and you held it for 40 years, what do you think this little term would turn out to be? Big or small? Real small, yeah. So if you do the present value calculation of this, so for long-term investing, which we'll talk a lot about in this class, for a long-term hold, kind of a buy and hold strategy, this term kind of disappears. And what we're left with is effectively this chunk, the present value of the dividend stream. So that's an important little assumption that we make with the generalized dividend model. So if Pn is far in the future, so kind of a long-term hold concept, then we're going to just axe off that term. So then our stock price is simply equal to the dividend stream, which is I equal T starting at 1 from T equal 1 up to infinity if there's running indefinitely, and then take that dividend amount, discount it by your required return, raise it to the T power, and we got this nice simple thing that only depends on dividends. And what we've effectively done is just said this thing equals 0, or approximately 0. Put some little squiggly equal sign. That thing's approximately 0 for a long-term hold. And so this is our result. that we get with the generalized dividend model. Okay, questions on that? Yeah.
How long do you consider long term?
Well, I mean, for holding purposes, I mean, 5-10 years minimum, I'd say. There's no magic number for that. For this particular model, whether this is a relevant tool or not, it depends on, does this thing approach zero as far as you go out? So then it's just a mathematical thing. Take the Apple stock price, what you think it's going to be 5 years from now, maybe it's going to be a little bit higher or whatever, divide it by this factor and see what that drops down to. If that gets pretty close to zero, then we're approximating this formula. Okay? Anything else? Yeah?
Why do you have it going off the
Just to say that there's no end there's no end specified. So instead of 10, so yeah, it kind of plays into Austin's. So time period 1, 2, 3, instead of saying 10 time periods or 5 time periods, so instead of going t equals 1 to 10, t equals 1 to n, we're going to treat it infinitely, and then that kind of changes. The bottom line is it changes some of the mathematics of it, so that you've got this infinite series, and then that's going to take us one more step into the next model. Okay? Good questions? And for some people, long-term hold means I don't know how long I'm going to hold it. So what should I base this off of? Guess as to what the stock's going to be 5, 10, 20 years. Is the company even going to still be in business? So the best I can do is kind of look at this dividend stream. Okay, anything else? All right, so Katie brought up, what if dividends grow? How do we estimate the price by saying the company was kicking out $10 a year per share dividend, but we're expecting that to grow over time? So what if dividends grow? All right, so our formula here gets modified. So if the dividends are expected to grow by 3% a year, some of you mathematical people, what goes on with this? So use this formula and tell me what modification we might make if the dividend is expected to grow by 3% a year. Okay, good. So if it's $10, if the dividend payment, if D's 0, the dividend today is $10, D1 is going to be equal to 10 times 1 plus 0.03 if we're using 3%, right? And that's going to give us $10 and how much? 30 cents? So $10.30. Right? So this 1 plus I business always comes in handy for calculating next time period's amount. So that's a little trick that we use. Now, what is D2? Okay, 1030 times 1 plus 0.03 equals whatever.
10 times 1 plus 0.03 squared.
Yeah, you seeing that? That's the same thing we did with present value. That's the same little deal we do, is if we take 1030 is really this. So we could substitute that. We've got 10 times 1.03 times 1.03. 10 is actually D0. Right? So all of this connects back to today's dividend. That ends up being important with the stock valuation by applying this growth rate. So what we end up getting here is really 10 plus 0.03 squared is a shortcut way. And now we're right back to D2, raise it to the 2 power. We're going to connect in that growth rate into this formula. All right, so let's do it. So P0 equals the sum of t equals 1 to infinity times d0, the initial today's dividend growth rate, times 1 plus g, which is the growth rate that we're going to assume on dividends, raised to the t power. Let me pause there before we do the denominator, even though the denominator is kind of easy, but I want to focus in on this. This is what we just did right here, right? So for the summation tells us we're going to do that for each time period. D1 is going to evolve. It's going to be 1030 for time period 1, and then it's going to get bigger and bigger as we move forward. Okay, everybody cool with that? Divided by the same thing we have. 1 plus ke raised to t power. So the only thing different between the generalized dividend model and what's going to be called the Gordon growth model is this little addition of assuming a growth rate on dividends. All right, now I will let you, I am not going to do this proof. This ugly monster, through the wonder of mathematics, evolves into D1 divided by KE minus G. Isn't mathematics wonderful when it simplifies things down to that? So that ugly beast turns into that. That's in your textbook. He shows the little proof for it. So if you guys want to, you math geeks out there, if you want to challenge yourself, there's your proof. Prove that this equals this on a blank sheet of paper, and then you can go to your textbook and see if you want to do it. Some of you people thinking about graduate school, you might run into some garbage like this. But for us normal people, we just take this shortcut method and we say, hey, that's easy enough, right? Okay, so this is called the Gordon growth model. The Gordon growth model. So some of the assumptions we got to be careful of. Number one is that dividends are assumed to continue to grow at a constant rate forever. That's not totally likely, so we've got to be careful with that one. Dividends are assumed to have constant growth rate forever. So there's some risk with that assumption. And the growth rate, let me just insert for, just put that little g, that's our assumed growth rate. I didn't define that variable earlier. So number two is that g is assumed to be less than ke, or required return. And this one's kind of easy to digest. If we think back to what you want to earn on the stock, if the growth rate of the dividend is 20% and your required return is 10%, would you want to buy that stock? Does that sound like a good buy if the dividend grows by 20%? Yeah, it's like kind of a no-brainer. The math doesn't work out if you, this equation doesn't work, so part of the proof of saying this is equal to this little simple thing, you have to assume that k is greater than g, and you see that in the denominator here, this would be negative, right? So that's all it's saying, is k's got to be greater than g for that, for us to get meaningful results. All right. So let's work through some problems. where you're at. So these are from your, well, I modified them actually. This is a slight modification from the back of your book. So go ahead and work on them. So number 22, compute the price of a share of stock that pays $1 per year dividend that you expect to be able to sell in 1 year for $20. Assume you require a 15% return. So compute the price of that stock. Sure. As long as you've got it airplane moded up. Oh, what happened to this? Oh, there we go. As soon as you get an answer, why don't you blurt it out? 1826. That sounds right. Let's see, it sounds right. On this particular one, just use the.
That's what I got too.
Got a second on that. Good. All right. So we got on problems like this, if it's a short answer problem at some point in time, write down your formula somehow with 1 plus the 8 raised to 1 power plus dividend. So what do we get here? $20. I did it kind of backwards, I guess, maybe in the way I presented it to you. Got a 15% return, so 1.15 plus the $1 divided by the 1.15, 1826. Is everybody okay on that? Looks like people jumped on to number 22. Good. So Gordon growth model. After careful analysis, you determine that a firm's dividend should grow at 7% on average in the foreseeable future. The firm's last dividend was $3. Compute the current price of this stock, assuming the required return of 18%. As soon as you get an answer, blurt it out. 2918. Got a second on that, so 2918. So we're just going to take that dividend of $3 and divide it by, we got 18%. And then what do we do? Minus or minus the 7% growth? And we get our.
That's, you have to take the 3 times 1.07.
Oh yeah, 3 times 1.07. Okay. And that gives you the 29. 18. So that's the one little thing on the formula we put D1. So D0 is what you know it to be today, and you think it's going to be 7% higher the next time period. You get that? Good? Everybody on track with that? All right, so now we get into, these are some things that I don't have the answers to. How does our answer change? If Russ has some information from his golf buddy that is managing director of Goldman Sachs, Russ perceives the stock to be less risky and therefore lowers his required return to 10%. What'd you come up with?
107.
How much?
107.
107. Woo! Okay. So 107 bucks?
Yep.
Alright, so we got growth model here.
Getting a little risque on seed.
Now, does that go the direction that you think it would go?
Yeah, because your growth is getting closer to your required return on capital, and so you're getting,
Was that 107 even, by the way?
yeah.
Okay. All right, so we got stock prices going up. Now, let me pause there for a second. Is that stock price actually going up? Or what's going on with this problem with Russ?
More of a willingness to pay.
Okay, we're kind of getting into the difference between our willingness to pay. In other words, am I going to go, if that stock price is actually trading at $29.18, am I a buyer?
Yeah.
Yeah, I'm jumping in. How much am I going to keep buying as other people start to figure out the information going on that it is a good buy, the price starts to rise? When do I quit buying? At 107. So yeah, it kind of shows the maximum willingness to pay. We're taking the model and we're putting in my information set into it. And then lastly, we got Bernie. This was inspired by Bernie Madoff, by the way. So suppose Bernie is having an affair with the CEO of the company. In the heat of passion, she blurts out some inside information that is very favorable to the firm. If Bernie's required return drops to 3%, what does he now value the stock price at?
Doesn't exist. Model fails.
All right. So we got some model failure. What's really going on? What is Bernie valuing the stock at?
Willing to buy it, whatever.
So what might we call that mathematically? Yeah, as high as you, whatever the price is, I'm buying. I've got information that nobody has. So this is kind of insider information. The way it works is that if you've got inside information and you feel confident, now is there risk for Bernie with inside information? In multiple ways. Now we could get into a more rich model that talks about jail time, right? Fines, fees, court costs. So we could get into a richer model that would get into that evaluation. But from this point, it basically starts to drive it up to infinity. So as if instead of 3%, if Bernie would have valued it at 7.1%, what happens to the valuation? Why don't you run that calculation? What if it's, yeah, let's I'm just curious what that number comes out. We'll do both answers here. So with this, G is greater than KE, so model does not apply. Kind of maybe infinite value
You set it at 7.01.
minus jail time.
Would this be one of those, the limit does not exist?
Fees. Okay, so my third part here is what if KE equals 7.1%, 7.10. What did you end up getting for the price?
3,210.
$3,200
$3,210.
and $10. $3,200 and 10 cents.
No. 32.
To the raise to the 10?
No, 32 10.
Like 3210.
Oh, 3210.
Sorry, I guess.
$3,210.
Yeah, perfect. I actually said that wrong, but yeah, that's.
Alright. So $3,210. Again, applying the model. Maybe I'll go ahead and do this one. We got $3 times the 1.07 divided by 7.1 minus 7. Okay. So everybody got a feel for this now on how this stuff works with thinking about stock prices? Okay, so now you can start to see what drives prices at individual levels is that this opportunity cost concept of different people having different required returns leads to a marketplace of buyers and sellers. That they think it's a good buy at $9.75. Other people say, no, that's junk. We might be analyzing the exact same stock with the same underlying fundamentals, no inside information, nothing like that. We're looking at the same information, but we're going to have various estimated valuations on stocks depending on people's preferences or their particular situation with required returns. Okay, so I'm just going to touch on what we're going to hit on Friday, and that deals with how we form expectations. So we're going to talk about rational expectations and how that plays into our predictions of the market in general and individual stocks. So the early models, before rational expectations was really developed by economists and financial economists, we thought of expectations being adaptive. Does anybody remember that from either other courses or if you read Chapter 7? Adaptive expectations as opposed to rational expectations.
Rational expectations deal with having complete information, and adaptive, it's dealing with the information that you've got and changing your expectations depending on the new information.
Okay, so yes, so the adaptive is more on history. We're I conceptually kind of think of it as adapting to what it was historically. So imagine I'm trying to map out that stock price. Let's see. Because this thing shows what this company has been doing. Boy, this is through the day. Yeah, this is just the day. This is what's been climbing. So I guess we were at the close. The previous close was 925. So this company popped up on the radar because something's going on here, right? This is a hot one today. So we can use that whether this has been the last 4 years or whether this has been the last few hours. We can talk about the idea of adaptive expectations. What do I predict it's going to be at 12 p.m.? Well, if the trend line's going up, I can take kind of a simple average of what was it at 11 a.m., what was it at 10 a.m., and then I kind of look at that trend and take the average of the two. And then I can get fancy and maybe put more weight on this 11 o'clock hour as opposed to the 10 o'clock hour. So there's kind of some fancy maneuvers that can be done there. But the point is that I'm going to change my expectation about next hour each time I gather more hours. So by the time it's noon and I'm trying to predict 1 o'clock, I'm going to add the noon valuation onto the previous two. See how I'm just kind of adding new data each time, taking the previous history, and that's what my prediction for next time periods. Oh, wow, impaled it and everything.
I know.
So my prediction next time period is always based on what the previous history was. And then we'll contrast that with rational expectations.
I was just going to say, can we just use some of the headlines that are right there to kind of help broaden some of our adaptive expectations, like being upgraded by Northern Capital